Hello students, welcome to the lecture on cost of capital, and after the lecture we will be able to learn the following objectives. Explain the concept of cost of capital, discuss the classification of cost, define computation of specific cost of capital, define the cost of debentures, debt, public deposits, understand weighted average cost of capital, discuss marginal cost of capital MCC, discuss factors affecting weighted average cost of capital WACC. Let's start with a brief introduction to cost of capital. Investment decision is major decision for an organization. Under investment decision process, the cost and the benefit of prospective projects is analyzed and the best alternative is selected on the basis of the results of analysis. The benchmark of computing present value and comparing the profitability of different investment alternatives is cost of capital. Cost of capital is also known as minimum required rate of return, weighted average cost of capital, cut-off rate, hurdle rate, standard return, etc. Cost of capital is determined on the basis of component cost of financing and proportion of these sources in capital structure. Now we will understand the concept of cost of capital. The concept of cost of capital is very important in financial management. It is weighted average cost of various sources of finance used by a firm, may be in form of debentures, preference share capital, retained earnings and equity share capital. The rate we use to discount an organization's future cash flows back to the present is known as the organization's required return or the cost of capital. Cost of capital is an important component of business valuation work. Because an investor expects his or her investment to grow by at least the cost of capital can be used as a discount rate to calculate the fair value of an investment's cash flows. Investors frequently borrow money to make investments, and analysts commonly make the mistake of equating cost of capital with the interest rate on that money. It is important to remember that cost of capital is not dependent upon how and where the capital was raised. Let's talk about the importance of cost of capital. The progressive management always likes to consider the cost of capital while taking financial decisions, as it is very relevant in the following spheres. Designing the capital structure. The cost of capital is a significant factor in designing a balanced and optimal capital structure of a firm. While designing it, the management has to consider the objective of maximizing the value of the firm and minimizing the cost of capital. Capital budgeting decisions. The cost of capital sources as a very useful tool in the process of making capital budgeting decisions. Acceptance or rejection of any investment proposal depends upon the cost of capital. A proposal shall not be accepted till its rate of return is greater than the cost of capital. Comparative study of sources of financing. There are various sources of financing a project. Point of time is to be decided by comparing the cost of different sources of financing. The source which bears the minimum cost of capital would be selected. Evaluations of financial performance of top management. The cost of capital can be used to evaluate the financial performance of the top executives. Such as evaluations can be done by comparing the actual profitability of the project undertaken with the actual cost of capital of funds raised or financed the project. Knowledge of firm's expected income and inherent risk. Investors can know the firm's expected income and risk inherent therein by cost of capital. If a firm cost of capital is high, it means the firm's present rate of earnings is less, risk is more and capital structure is imbalanced. In such situations, investors expect higher rate of return. Financing and dividend decisions. The concept of capital can be conveniently employed as a tool in making other important financial decisions. On the basis, decisions can be taken regarding dividend policy, capitalization of profits and selections of sources of working capital. Here we will discuss about the classification of cost. There are various types of cost as historical cost and future cost. Historical cost represents the cost which has already been incurred for financing a project. It is calculated on the basis of the past data. Future cost refers to the expected cost of funds to be raised for financing a project. Specific cost and composite cost. Specific cost refers to the cost of a specific source of capital such as equity share, preference share, debenture, retained earnings, etc. Composite cost of capital refers to the combined cost of various sources of finance. In other words, it is a weighted average cost of capital. Average cost and marginal cost. Average cost of capital refers to the weighted average cost of capital calculated on the basis of the cost of each source of capital, and weights are assigned to the ratio of their share to total capital funds. Marginal cost of capital may be defined as the cost of obtaining another rupee of new capital. Explicit cost and implicit cost. Explicit cost refers to the discount rate which equates the present value of cash outflows or the value of investment. Thus, the explicit cost of capital is the internal rate of return which a firm pays for procuring the finances. On the other hand, the implicit cost represents the rate of return which can be earned by investing the funds in the alternative investments. Let's know about the computation of specific cost of capital. Computation of cost of capital from individual sources of funds helps in determining the overall cost of capital for the firm. There are four basic sources of long-term funds for a business firm. The cost of long-term debt. Cost of long-term debt represents the minimum rate of return that must be earned on debt-financed investments if the firm's value is to remain intact. Long-term debt may be issued at par, at premium or discount. It may be perpetual or redeemable. The formula for computing the cost of long-term debt at par is shown on the screen, where K equals to cost of long-term debt, T equals to the marginal tax rate, and R equals to the debenture interest rate. The cost of preference capital. The cost of preference share capital represents the rate of return that must be earned on preferred stocks financed investments to keep the earnings available to residual stockholders unchanged. Cost of preference shares can be estimated by dividing the dividend stipulated per share by the current market price of the share. The formula is shown on the screen. The cost of equity capital. In a nutshell, it is the discount rate which equates present value of all expected dividends in future with net proceeds per share current market price. It represents the minimum rate of return that must be earned on new equity stock financed investment in order to keep the earnings available to the existing residual owners of the firms unchanged. The cost of equity capital is measured by earning the price ratio. The formula is shown on the screen, where E equals to the current earnings per share, P equals to the current market price per share, and now the cost of retained earnings. Corporate managers and some analysts normally consider the funds retained in the firm as cost-free funds because it does not cost anything to the firm to make use of a part of its earnings not distributed to the shareholders. Algebraically, the approach can be explained as shown on the screen, where KE equals to the cost of equity capital based on capital growth method, TR equals to the shareholder tax rate, B equals to percentage brokerage rate. Now let's talk about the cost of debentures, debt, public deposits. The cost of debt is the interest rate that the organization pays on its debt content of the capital structure. It can be measured as before tax cost of debt or after tax cost of debt. A debenture is an instrument of debt executed by the organization acknowledging its obligation to repay the sum at a specified rate and also carrying an interest. It is only one of the methods of raising the loan capital of the organization. Public deposits are an important source of financing the medium-term and the long-term requirements of an organization. The term public deposit implies any money received by an organization through the deposits or the loans collected from the public. There are several advantages relating to public deposits. It is an easier method of mobilizing funds, especially during periods of credit squeeze. The administration cost of deposits for the organization is lower than that involved in the issue of shares and debentures. The rate of interest payable by the organization on public deposits is lower than the interest on loans from banks and other financial institutions. It helps the organization to borrow funds from a larger segment of the public and thus reduces the dependence of the organization upon the financial institutions. It also enables the organization to create contact with a large number of investors. It ensures the availability of funds for a longer duration, and it provides flexibility to the financial structure of the organization. There is no dilution of shareholders' control as the depositors have no voting rights and cannot interfere with the internal management of the organization. Public deposits has its own limitations, like as the public deposits are more likely to be affected by the uncertain conditions in the economy. The depositor's response may vary accordingly. Public deposits with the companies may cause a diversion of resources into non-priority and undesirable areas. Professional investors may not like to invest in such deposits as there is no or less chance for capital appreciation. As public deposits are unsecured, the depositors may have to bear the risk of loss of money in the event of failure of the organization. Widespread use restricts the growth of a healthy capital market. Here we will discuss about weighted average cost of capital. The capital raised from various sources is invested in different projects. The profitability of these projects is evaluated by comparing the expected rate of return with overall cost of capital of the firm. The overall cost of capital is the weighted average of the cost of the various sources of the funds, weights being the proportion of each source of funds in the total capital structure. It is also termed as composite cost of capital or overall cost of capital or average cost of capital. Weighted average. How to calculate? Its computation requires assignment of weights. First of all, weights have to be assigned to each source of capital for calculating. Computation of specific cost of each source. After assigning the weight, specific cost of each source of capital, as explained earlier, are to be calculated. In financial decisions, all costs are after-tax cost. Therefore, if any source has before-tax cost, it has to be converted into after-tax. Computation of weighted cost of capital. After ascertaining the weights and the cost of each source of capital, the weighted average cost is calculated by multiplying the cost of each source by its appropriate weights, and weighted cost of all the sources is added. This total of weighted cost is the weighted average cost of capital. The formula shown on the screen may be used for this purpose. KW equals to weighted average cost of capital, X equals to the after-tax cost of different sources of capital, W equals to the weights assigned to a particular source of capital.
Cost of capital is the capital. When we talk about capital here, we mean the capital that the company uses to invest, and it gets that from equity, from shareholders, and it also gets it from debt holders. And of course, you know, the shareholders don't give the money for free. They want something in return. The debt holders don't give the money away for free. They want something in return. Okay, and we call what they want in return the costs for us. So what I'm looking at here, though, is just the numbers. So let's say that we've got $1,000 worth of equity, and we have $4,000 worth of debts. Okay, so in total we have capital of 5,000. I'm not talking about the costs here, I'm just talking about the total, because we've got to average this up according to their total amounts. So we've got total 5,000. Now the cost of equity is 10%, and the cost of debt, because they take less risk, is lower at 5%. So on average, what is the cost of capital? Because cost of equity is 10, cost of debt is 5. Does that mean on average then it's 7.5 in the middle? No, it doesn't, because we haven't got as much equity as we've got debt. So what we have to do is weight it up. And the way we do that, we say, right, we've got 1,000 of equity, we've got 4,000 of debt. That means I've got 5,000 capital in total, which means in terms of equity then, 1,000 out of the 5,000 I'm being charged at 10%. And then for the debt side, 4,000 out of the total 5,000, I'm being charged a cost of 5%. So you just simply multiply those through. So 1,000 divided by 5,000, so a fifth, times by 10%, a fifth of 10% is 2%. Over on the other side, 4,000 divided by 5,000, or 4/5, times by 5% is 4%. Add those two together, and that is how you calculate the weighted average cost of capital. Okay, and it's that figure that you're going to use in your MPVs, the 6%. Now, a couple of things then, because obviously it's not quite as easy as that. Few things, there's different sorts of debt, there's different sorts of equity, but this is the basic principle. And what we have to be aware of are those two figures there, because I was just saying we had £1,000 worth of equity and $4,000 worth of debt or whatever, and it could be book value or it could be market value. Unless you're told otherwise, always go for market value, okay? But just be aware, and we'll look at how we work out book and market value later. And then the other big thing in this little calculation is obviously the 10% and the 5% figures. Now, they're big sections, of the syllabus. They're big chunky parts that we look at later on in the course. How to calculate cost of equity, how to calculate cost of debt for the different sorts of debt. Okay, but what I'm looking at here is, once we've calculated cost of equity, cost of debt, once we know what the book or market value is, how do we then bring it all together to work out a cost of capital? So I'm kind of starting at the end, and then we go on to the individual bits later. Okay, so using that idea, remember then, cost of capital is made out of cost of equity and cost of debt. And the first thing I said was, yeah, you can have $1,000 of one, $4,000 of the other. And I said that those two, look, could be book or market value. And I want to concentrate on that bit. First of all, how do we calculate these figures? Right. So here's a typical equity part of a balance sheet. And you can see there, that's in the books, yeah? So you can see that in the books there is $3,000 worth of equity in the books. But I also get told that the market value of the shares is $5 each. Okay, book value then is simple as that. That is the book value. $1,000 plus the $2,000 retained earnings, use everything that's in equity in the books, done. The answer is $3,000. If, however, though, he says, well, actually, no, I don't want it based on book values, I want it based on market values. Well, on market values, never, ever, ever take into account anything except the share capital. And you don't just take the share capital. You take the share capital, the number of shares, times by the share price. So the market value is 5,000. Never take into account retained earnings or share premium, etc. Only do that when you're doing book value. Market value, there's only one thing that has a market value, and that is the shares themselves in equity. Okay, now let's have a look at debt. So there's a balance sheet for debt, could be whatever sort of loan, and it tells you that it's 1,000. Well, that's the book value then. Okay, but he also tells you the market value of debt is 105. Well, when I'm looking at book values, I don't care about market value. So the book value is actually 1,000. What about then market values? Well, I did say that this market value of debt was 105, and debt is always quoted per 100. So that has a market value of 105 for every 100. So to work out the true market value of that debt, you simply times it by 105 over 100, and the market value would therefore be 1,050. Okay, so let's have a look at this then. We've got some share capital, we've got some retained earnings, we've got a loan. That's in the books, yeah? That's the book value. I also get told some market values, okay? I'm either going to use book values or I'm either going to use market values depending on what the examiner tells me. If he doesn't tell me anything, I'm going to use market values if I can. He also tells me the cost of debt and cost of equity. In the real exam, you'll probably have to calculate those as well. Okay, so let's calculate this weighted average cost of capital. Remember, cost of equity, cost of debt, and it's these figures here that I'm trying to get at the moment. Do I use book values? Do I use market values? What am I going to do? Okay, first one we're going to use then is book values. So go again, book values. What's the book value there of the equity? Now I'm hoping you're thinking to yourself 3,000. Yeah, and if you are, you're absolutely right. And for the debt, I'm hoping you're just saying 1,000. You're ignoring completely the market values because we're just looking at book values. And you'll be absolutely right. So let's finish that off then. Cost of equity, cost of debt. Using book values, cost of equity is 3,000, cost of debt is 1,000. Cost of equity is 10%, cost of debt is 5%, I get told. Now just weight it up. 3,000 cost of equity out of a total of 4. Cost of debt 1,000 out of a total of 4. Multiply it through them. 3/4 of 10 and 1/4 of 5. 7.5%, 1.25%. Add the two together. The weighted average cost of capital there using book values is 8.75%. Let's do exactly the same. This time using market values. Hopefully you understand why I've put the big line through that, because when it comes to market value of shares, I'm only interested in one thing, the share capital, and I'm interested in its market value, which I get told is $5. So therefore the market value of equity is 5,000. As for the loans, the market value of the loan is not 1,000, it gets quoted at 95 out of every 100, so times by 95 over 100 is 950. That's the market value of debt. Pop that into our little formula here. Cost of equity, cost of debt as normal, it's these figures. The cost of equity market value, or equity market value, 5,000. Debt market value, 950. 10% and 5% still of the actual costs. All I've got to do is weight it up now. 5,000 out of 5,950, 950 out of 5,950. So 5,000, 5,950 times by 10%, 950 over 5,950 times by 5%. You should get, with a bit of rounding, 8.4 and 0.8. Add the two together, and you've got your weighted average cost of capital using market values of 9.2%. Okay, that just leaves us now then to look at cost of debt and cost of equity in more detail so we can calculate them.
Now let's look at the merits and the limitations of weighted average cost of control. The WACC offers a number of advantages, including the followings: straightforward and logical. It is the straightforward and logical approach to a different problem. It depicts the overall cost of capital as the sum of the cost of the individual components of the capital structure. Responsiveness to changing condition. Since it is based upon individual debt and equity components, the weighted average cost of capital reflects each element in the capital structure. Accurate when profits are normal. During the period of normal profits, the weighted average cost of capital is more accurate as a cutoff rate in selecting the capital budgeting proposals. Ideal creation for capital expenditure proposals. With the help of weighted average cost of capital, the finance manager decides the cutoff rate for taking decisions relating to capital expenditure proposals. Limitation of WACC. It is unsuitable in case of excessive low-cost debts. Short-term loan can represent an important source of fund for firm experiencing financial difficulties. Unsuitable in case of low profits. If a firm is experiencing a period of low profits, not earning profit as compared to other firms in the industry, WACC will be inaccurate and of limited value. The difficulty in assigning weights. The main difficulty in calculating the WACC is to assign weight to different components of capital structure. The selection of capital structure. The selection of capital structure to be used for determining the WACC is also not an easy job. Three types of capital structure are there, that is current capital structure, marginal capital structure and optimal capital structure. Here we will understand the meaning of marginal cost of capital. The marginal cost of capital is calculation of the cost of additional funds to be raised. Marginal weights represent the proportion of various sources of funds to be employed in raising additional funds. Marginal cost of capital is the cost of raising one more unit of capital. If organization raises more capital, the cost of capital will also raise. Suppose our cost of capital is 10% average for rising from share capital, debt and public deposit. But if we are interested to raise one more dollar, we have to pay extra cost, and this cost will be marginal cost of capital. If organization has enough retained earnings, then the organization can use this. With this, weighted average cost will be almost equal to marginal cost of capital. Now, the question is how to calculate the marginal cost of capital. For calculating the marginal cost of capital, we see both our current cost of capital and the risk level. We have to give high cost of capital if we use this money for risky project. The demerits. It ignores the long-term implications of the new financing plans. It fails in achieving the wealth maximization objective in the long run. And now we will talk about the factors affecting the weighted average cost of capital. The cost of capital is affected by a number of factors. Some are beyond the firm's control, but others are influenced by its financing and investment policies. Controllable factors affecting the cost of capital. Capital structure policy. Firm has control over this capital structure, targeting an optimal capital structure. As more debt is issued, the cost of debt increases, and as more equity is issued, the cost of equity increases. Dividend policy. Given that the firm has control over its payout ratio, the breakout point of the MCC schedule can be changed. Investment policy. It is assumed that when making investment decisions, the organization is making investments with similar degrees of risk. If an organization changes its investment policy relative to its risk, both the cost of debt and the cost of equity change. Uncontrollable factors affecting the cost of capital. The level of interest rates. The level of interest rates will affect the cost of debt and potentially the cost of equity. For example, when interest rates increase, the cost of debt increases, which increases the cost of capital. Tax rates. Tax rates affect the after-tax cost of debt. As tax rates increase, the cost of debt decreases, decreasing the cost of capital. Now, in the end, let us summarize what we have learned in this lecture. The cost of capital is also known as minimum required rate of return, weighted average cost of capital, cutoff rate, hurdle rate, standard return, etc. The rate we use to discount an organization's future cash flows back to the present is known as the organization's required return or the cost of capital. An organization's overall cost of capital is a mixture of returns needed to compensate all the creditors and the stockholders. The average cost of capital refers to the weighted average cost of capital calculated on the basis of the cost of each source of capital, and the weights are assigned to the ratio of their share to total capital funds. Cost of long-term debt represents the minimum rate of return that must be earned on debt-financed investments if the firm's value is to remain intact. The overall cost of capital is the weighted average of the cost of the various sources of the funds, weights being the proportion of each source of funds in the total capital structure.